Okay, friends, welcome to night 3 of our 3-night mini class in investing and stepping into a new investing playbook in a world that is, it seems like it's changing by the minute. So we're going to try to tie some stuff up and be really, really practical. I would say up front, just some upfront contract. This is going to get pretty technical pretty fast. The beauty of having a recording that you can go back and look at, do that. And then also as I go through things, make notes if there's something that doesn't make sense, or you're like, hey, slow down. You can use the chat in live, and we'll respond that way. But you can also shoot us a message afterwards, and we'll reach out and do some additional follow on to make sure that you get as much insight as would be helpful. So with that, let's jump in, shall we? And let's start wading through all that we have to get through. So tonight is how to step into a new investing playbook that can help you achieve your goals. Let's start with a review. So night 1, we talked about who am I as an investor? Am I an active investor, or am I an investor, or am I a trader? We're in the active investing is a great place to be. This is a place where you're taking on more responsibility for the outcomes of your investing, but it's not like a trader who is saying, I will drive the outcomes, and it's not like an investor who says, I'm deputizing them. So if we want better outcomes, what we do is we take more ownership for that. And then we also are clear on what do we want for investing? Are we investing for retirement? Are we investing to buy a home? Are we investing to generate additional income? What is the objective? What would good look like? That can drive, where I am in terms of the activity as I'm looking to invest. And then if I step out and start to move in that, what is it? What are the things that I believe about investing, and what outcomes are created by activity that get me where I want to be? And are there things about that may need to change? Am I open to information that would suggest perhaps that may need to change? Because there is a reality, especially if we're talking about in capital markets or financial markets, that there are things that never change. And one of those is the fundamental, which is human behavior, that does not change. The way that's engaging, the way that engages changes. And so am I tuned to that can really help me be effective as an investor. Then we talked about how the current playbook that has been in play and used specifically for investing for retirement for several decades has actually a pretty short recency. It's not very old, and there are parts and reasons for why it worked really, really well for a number of years, and that no longer is in play. And so being aware that yes, this did work. Yes, I will hope people say that's what it's worked historically. That does not present a prediction of what will happen in the future. And so then how do I think about that if I'm going to go and work on my outcomes? And so all of that leads to say, I can achieve the outcomes by turning 2 dials. What is the playbook? Can I get a playbook that can give me a higher yield than what the old playbook does, or the existing playbook? And am I willing to have some ownership around that, which can then help me get into that playbook to get that yield? And that all rolls up into a process, and that process is actually the profit. This is one of the skills to cultivate if you want to get to the investing outcomes that you want, is you have to disconnect the outcome of the investment from the process upon which I selected and managed an investment. Because anyone who's been an effective investor for any period of time will tell you there are no guarantees in investments. And in fact, I will have several that won't work. Just this morning, I think I mentioned this in the other class, I was talking about the angel investors. And someone who is an active angel investor, one of the things that you learn is that most of them will not work. So part of my process is actually the deal flow. I have to be in enough of them to get there. It's like someone who does direct outbound cold sales, right? They know it's a numbers game. If I know that I'm going to hear lots of no's, but if I get my quantity of knocking on doors high enough, I'll still get to the outcome that I want. That becomes part of the process that leads me to the outcome that I want. The process itself is the profit. Now, to be fair, it has to be a process that I have trust in, that if I hold to, will still get me the outcome that I want. All right. So that it's not just the process, but it is the process around something that actually does actually work. Okay, so then last night we talked about, okay, with this framework, let's step further into this. There is a discount among many who would want to be investors that the one tool you have that you can use is risk. Like, it is the guarantee. It is like death and taxes. Risk is the piece that I have ultimate control over. I can control where I invest, when I invest, how much I invest. I can't control the outcome, but I can control the lever that leads to the outcome and exposes me to the outcome. As we were reminded that as investors, we are paid to warehouse risk that a market does not want. So unless I'm willing to warehouse that, like, that risk is the way that I can get that. If there is no risk, there is no return. So then risk becomes the thing that I can use. And how do I think about using that? We even talked about, how effective, professional or institutional investors think about risk, and then how does most retail investors think about risk. They're all about the opportunity, but they discount that, no, there is risk. So I need to be risk forward. I mean, like years ago, I went to work for a firm, and we specialized in risk management. And because I came from a retail investor world, I was like, well, I don't even know what that means. Like, why do they keep hammering like it's all about risk management? It's all about risk management. Oh, because, and these were effective investors because they knew that was the lever that they could actually move. So risk management is the missing skill. Then we start talking about how options matter in modern markets, and we'll talk more about this tonight. This is the really heady piece of this equation. It can get really thick really fast, but the shorthand of it is that we live in a world where the tail wags the dog. We have stocks and we have ETFs, or exchange traded funds. There's about 8,000 of them in the US alone. And most of them have these options or these contracts that are derivatives of these asset vehicles. And they take their pricing from them, but it's not just that. They actually create feedback loops that can introduce probabilities of whether or not something can happen at some point in the future. And so just to illustrate that, as a reminder, I'm going to pull over a chart here, and we're going to take a look at, we talked about option chains a little bit, things that are changed to an underline. But here's an option chain of NVIDIA again, and these are different. You'll notice these are strike prices. Again, these are calls and puts. Calls and puts are options. They're coupons that give someone who buys them the right, not the obligation, to take a certain action at a certain period in time. And some of these are for things that happen tomorrow. Some of these are things that happen in January of 2027. But each one of these prices, or these strike prices, are where I can make a decision around. So like, let's just use tomorrow, for example. Okay. Here I am. NVIDIA today closed at 186 a share. Okay. So if I go down here and look at the 200 strike price, I can buy a call option that gives me the right, not the obligation, to buy NVIDIA at $200 a share tomorrow. And I could pay 3 cents per share to buy that contract. Now, why would I do that? Okay, well, there is a potential. Now, it's not likely, but there is it could happen that, let's say that NVIDIA, something happened overnight and we cured cancer, and NVIDIA was the one who figured this out. And tomorrow, NVIDIA is at $250 a share. At the close, so if it's at $250 a share, and I buy the 200, I would buy the ability to buy it at 200 when it was at 250, which would effectively immediately give me $50 of profit per share, and I can buy that right now for 3 cents. Yeah, like, yeah, like, what would that mean? That would mean that because each option contract controls 100 shares, so 3 cents, it would go to $5,000 would be the multiple of this. Okay, so now, but is it likely? It is not likely. In fact, because all option transactions are transparent, there is a derivative of the derivative, a a second order derivative that we call delta. So you'll notice here on the put side and also on the call side, there's a delta, and there's a percent value here. This is the probability that we will be at that price at expiration. So let's look at an example over here where it says like a 99%. Well, that's for the 170 strike. Well, we're already at 186. So what's the probability that we'll be above 170 tomorrow? Very, very high. So that probability is high. But what's the probability that we'll be at 200? That, my friends, is 1%. Very low. And this is not just made up. This is really based on people taking positions because all of this is transparent. So this all causes a chain reaction or feedback loop that really dictates where things can go. Now, does it mean that there aren't places that we step beyond these? Absolutely. I mean, we've seen moves in the metals recently, like gold and silver. Some of these have been what we call black swans. So they're so far out of the normal distribution of samples that they're like not just one outlier, they're like 3 standard deviations from the mean kind of situation. In fact, there was a move several weeks ago in silver that the probability of you and I getting struck by lightning was actually greater than it having that move on that day. So there are things that happen in markets that this is the nature of probability, and the challenge around probability is it's not a guarantee, right? Donald Trump had a 30% probability of becoming president in 2016. Like was it likely? No, but yet we know, how that works, like where we are as a result of that. So, however, that there are times when probability doesn't bear out, but just like we talked about, the coin flip. Okay, if I flip a coin 10 times, I could land on heads every time. But if I do it over 1,000, most likely I will get to 50-50. So then as investors, the way that we beat predictions is we stack probabilities. So yes, can a black swan happen? Absolutely. But because it's so unlikely, if I build my approach to investing around black swans, I will not be effective. In fact, early in my career, I had a mentor who was teaching me about markets, and he had a perpetual posture of looking for and building a position around the black swan. And what I saw was someone who, like 99% of the time, was underwater because he was building it around what was likely not to happen. And then, like, when that unexpected thing happened, oh, it was great. But why incur that pain? Like, why? That's not an effective way, and effective investors don't do that. Effective investors build a system around what's the most likely outcome, and then we use risk as that tool. And the thing we'll talk about tonight around allocation to change my exposure so that when those things happen, those black swans happen, which they do and they will happen. And by the way, they happen as part of what we talked about last time around the idea that that humans as the behavior is the only fundamental. Well, humans at times act very irrationally. And these are that we see this at the black swans out here. We call them tail risk. It's like at the tail of the distribution, right? These things do happen. So an effective investor builds their approach thinking about how do I structure and use risk, and then allocation of capital. We'll talk about now, so that even though those things happen, it doesn't wreck me, and I'm able to recover. I had another mentor that always talked about, it was in the context of markets, but he talked about, don't go for perfect, go for adjustable. Okay? So like a lot of what we'll talk about tonight is like, how do I step into a playbook that thinks about black swans but doesn't build around them? How do I think about allocating so that even when they happen, it doesn't wreck me? How do I go for adjustable and don't have to be perfect? There's a lot about the current playbook that most people are brought into that almost needs it to be perfect. And that is part of the math that's preventing people from getting to their investing outcomes. Okay, so that's why options matter, and also why probabilities beat predictions. And then we also talked about how to be nimble, to like Bruce Lee says, be water was the idea there. Okay, so be water. So let's talk about where we're going to go tonight. So tonight we're going to talk about allocation as it's almost as important as the strategy. So like the playbook that I step in, yes, is it good to spend time thinking about the playbook and make sure that that's an effective playbook? Absolutely. But the way that I allocate capital to that and the risk around that is as important. Because if I put all of my chips, for example, in something and it doesn't work, then I'm done. Like I'm overexposed. But if I put some of my chips into something that doesn't work, okay. And this is also tied to another idea that we haven't talked much on, but you're aware of if you even know that the current playbook, and that is diversification, right? Well, we're going to talk about the diversification paradox. There are sometimes to be like, what does actual diversification mean, and where are we exposed to it in the current playbook that is that 35-year playbook? How do we think about diversification as we're stepping into a new playbook? And then how do we ultimately, in all of this, how do we cultivate investing confidence? Because stepping into anything new wrecks your confidence. It's a really clear way to get you off of your heels. It's when you think about people who are trapped in patterns that you look at and say, well, that's something that's actually not good for you. That's actually not helpful. And yet what leads them to continue to be in that? Well, it's known. And I have confidence that I can manage this thing, but I don't know about this other. So it could be better, but I don't know that. And that becomes a deterrent. So cultivating confidence when you step into a new playbook is critical to be able to do that. And then last but not least, we'll talk even like, okay, we in the beyond this night, at the end of these 3 nights, it's like, how do I complete my first 20 hours with a new investing playbook? So again, going back to night 1, we talked about Malcolm Gladwell in his book, The Tipping Point, talked about 10,000 hours as kind of the threshold upon which anyone can be at the top of their field in a highly competitive place. But then my friend Josh Kaufman in his book, The First 20 Hours, took that concept and said, hey, yes, to be the top in your field, a highly competitive field, you need 10,000 hours. But to be a pretty confident novice, I really just need 20 hours. But to do that, I need something that I can trust on the front end. So the first number of hours is really like, what is the thing? And then the last bulk of hours is, what's the deliberate practice that I go through that gets me there? Because that deliberate practice around something that I can trust is what builds that confidence. Okay, so that's where we're going to go in the next 40 odd minutes, and hopefully at the end of that you're just going to be ready for what's next. All right, so let's dive in, shall we? And go from here. All right, so the bots are coming. So this will date this session, no doubt, and that's okay. But in the last number of weeks, we have seen something called the SaaS-pocalypse, or the SaaS-pocalypse, the software as service apocalypse, as they called it, where companies that drive their revenue from software as a service have lost about $1 trillion in value. And this has been because of rapid evolving of AI, or the tools that we call AI, right? So whether that's Claude or ChatGPT or Kimi K2 or any number of these models that are out there, Gemini is another one, that are these large language models and are really changing everything. Like how do, especially if you're in a software business, how do you work? How do you even work within your business? Tools that people used to subscribe to, now they don't. And I'm seeing lots of people building tools using these types of instruments to help with investing. So I thought, well, let's start there, shall we? Let's load up Claude and let's walk through a way of thinking about investing. And what I want to show you is how we could even take the things that we've talked about in the prior nights with these tools and get better results. And also how, even though these things are evolving very quickly, they are as yet still regurgitating the playbook of the last 35 years. And this in itself is an insight into how these models work. So let's do this. All right. So I've got Claude here, and we've talked about NVIDIA a bunch last number of times. So I said, well, great. I'm interested in investing in NVIDIA. What should I do? And so what's great about this? It can literally go and pull up information about NVIDIA. It's like, where does it stand from its price? What's its market cap? What's its price to earnings ratio and dividend yield, and all of these things that people have assumed that are important around building the idea. Now, I want to pause here real quick because this is a hot take. The hot take is price to earnings ratios, dividend yields, and such actually don't matter. In terms of, is there a direct correlation between this ratio means I will see this stock price? We talked in the last one about the accounting equation. Assets minus liabilities equals stockholders' equity to get the book value of the stock. You can go back and look at that last night, and how there's always this disconnect between the street value and the book value. And what these things are helpful is they're help at carrying forward the story of a stock, but there's just not a direct correlation. So if you think, oh, I'm going to build this based on what that number is, as if the specific number matters, it doesn't. And I know that from having friends who've traded on the floors in Chicago, and like none of these guys read any of this stuff. Like nothing. They literally came in and they watched human behavior in the trading floor, and that was the guiding piece. So do these things help influence the story? Absolutely. But is there a direct line of correlation? I can save you lots of time by not having to look at this stuff, by just knowing that it really doesn't matter. So here is Claude giving us all this stuff. So, okay, before you invest, here are some practical steps to think through. So you want to ask yourself how much of your portfolio you're comfortable putting in a single. So that's an allocation question. I think that's a helpful one. You consider if you want, direct stock exposure, or if you want to have broader exposure through an exchange traded fund. And an exchange traded fund is a basket of named stocks, or they're within an index, and it's a way to give you an exposure to something without it being concentrated, because sometimes concentrated risk is bad because it can overexpose you to risk. So when we're talking about that risk, there's some wisdom here. They're good questions, but if you think about the 4 questions that we talked about within our process, this isn't part of the equation by a default. So then I go, okay, well, I've got $1,000. That's a risk. What's next? Okay, so it's going to start building a roadmap, and it says, open a brokerage account and define your approach. Is this going to be all in one lump sum? Is it dollar cost average? Is it mix it up? What's missing here, gang? What is missing? There's no where to go. So even though it's starting with, okay, this, but we talked about question 1 in the process is, what's the target? What do I believe is the hypothesis for where this will go? Because if I don't know what that is, I don't know how to measure the risk. It could be 1x, it could be 10x, it could be 100x. I don't know. And this is evidence of the classic playbook in play. And it should not be surprising, because these large language models are regurgitating the public, discourse, or what's publicly available. They are not, however, offering information from the firms that I know are exceeding the market. Those things from Jane Street last year had their highest trading record performance ever, or Renaissance Fund that Jim Simmons run. Nobody knows. That's not broad knowledge. It's not widely accessible. This old playbook is widely accessible, and it's one that does not articulate a target. They talk about tropes, right? Consider the timing, place your order, all that stuff. Okay. So it's here's a couple of those ideas. So I said, well, help me think through the approach. And so now it's all right, well, what's your comfort level? If you've ever opened a brokerage account, or, started looking at investing in equity things, these are the pretty standard questions. Okay, so it's well, what's your experience? Some experience. How long do you plan on to hold it? Less than a year. I mean, I don't know. I just threw something out. How would you feel if NVIDIA dropped 20% shortly after you bought it? I'd panic and want to sell. Okay, well, why? Well, if I bought this thing believing it was going to appreciate 100%, Yeah. So if it's at 186 and I believe it's going to go to 360, is 20% that much risk? No, but isolated, it feels like it, right? So this right here is when if I know the target first, I can answer this question better. But that's not how the playbook in play works. All right. So then, all right, based on this profile, I'm going to give you the regurgitated stuff that would be out here. Yada 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 yada. All right. So one honest caveat. I mean, I think this is helpful. Is it says, single volatility it could be risky. It's a great company, but it could swing 15 to 20% in a quarter. So if preserving your 100% is important to you, make sure you only, have some exposure or broaden the exposure to that sector, which could mean that rather than just having Nvidia, Nvidia may have a bad day, but these others in the general sector may be strong. Okay, that's what I say. Well, actually, I need time thinking about this with risk reward. So now I'm going to step in and use this tool with some of what we've already talked about. Look at the difference of the outcome. So, oh yeah, this is a great way to think about it. Of course, it is a great way to think about it. It says, well, look, there's earnings coming up on February 25th. So let's sketch out some scenarios from this 191 entry. So there's a bull case, a base case, a bear case, and then it has price ranges. Now, get this, gang. Where is it coming up with a price range? Now, you can go to CNBC or Bloomberg, or you'll hear some talking head talk about a price target for these things. So I was like, well, where does the price target come from? How are you determining that given the impact of earnings? That's a fair question. I should be transparent. Those are ranges, estimates of general knowledge of how they move around earnings. So let me give you something more data driven. And guess where it goes, my friends? It goes to the options market. The option market tells you what the market expects. And so it's saying, look, based on where we are, we're implying about a 7% move, or $13.45 from 191 for that February 25th report. That is the options telling the market where to go. And this, if you know the questions to ask, you can actually use tools like this you could use this to use the 4 questions and build an approach that's going to be fairly effective. And then what you see here is, options are what can actually dictate it. Otherwise, I'm just guessing. But this is going to actually give me a probable outcome. Now, it says an implied earnings move of 7%. Can it go beyond that? Absolutely it can. In fact, years and years ago, I bought a call option for right before Nvidia earnings. I paid $50 for that call. The next day it was worth $1,200. Wow. Okay, so why was it worth that? It was worth that because Nvidia, or Netflix, which was kind of the Nvidia of the time, moved beyond that expected range. And so that meant that option was underpriced relative to where things went. Flash forward in the couple times later, and I actually bought a Apple put at earnings, and Apple moved, I don't know if it was that put or call, but it moved a big move, but it was inside of the implied earnings range, and that meant that it was worthless. So in that case, the options were effectively priced relative to that, because they take their pricing based on the probabilities. So they're efficiently priced when they work within those ranges. When they expand beyond them is when you can see some pretty fantastic changes. And such is the nature of derivatives, derivative products taking their pricing from derivatives. Okay. So with that being said, the idea of the bots are coming. Let's now talk about allocation. Okay. Because allocation, along with risk, is a way that we can step into a new playbook and do so with confidence. So let's talk about, and this even happened today. I was talking to somebody within the office, and we were looking at her portfolio. And her portfolio, she looked inside of it, and it was 100% it was 100% allocated. Okay, meaning that the full value of her portfolio was into some vehicle. And it was the standard stuff. I think it's actually even a platform called Acorns. So if you've seen this one, where it automatically, basically it's going to replicate a classic financial advisor type portfolio, which means I'm going to have some exposure to the SPX. I'm going to have some exposure to some mid cap stocks. I'm going to have exposure to a 60-40 portfolio. Like nothing sexy, nothing unusual here. This is the old investing playbook that's been around for a while. But this is where I want to key into is the allocation bit. Okay. So I am of the opinion, now this is just an opinion, but I'm of the opinion that the things that I'm seeing, and also the things I'm seeing around AI specifically and how disruptive this is being, I think that this is the risk of this is underpriced in markets. And when you have something that's underpriced, that means that we'll get to a price. In fact, we talked about the way that we're paid as investors is we warehouse risk that the market doesn't want. So it turns out that there's only two edges that exist that pay investors. So one of them is where we have something that is mispriced. Okay? Another one is where there is a structural anomaly. All right, so let's talk about the mispriced one. I don't, let's say that we have an earnings event coming up, or we have an economic report or something out there, and I don't have perfect information. There are some out there that will talk about something called efficient market hypothesis. Let me try this again. Efficient market hypo. Right. EMH. Someone who's a high subscriber to the idea of EMH is that there actually is no way to make money as an investor because there's perfect information. And in a perfect information scenario, that means that everything is completely effectively priced. Therefore, there is no edge because I need there not to be perfect information to be able to get a return. Hence the mispricing piece. But as we talked about last night, when I have an adoption curve and I have different people coming on the curve, that participation is part of what reinforces both of these. Because we have some people who get good prices and some people who get bad prices, and how they're showing up as humans creates the mispricing structure that creates the opportunity. And then where I am in entering these ideas is part of saying, yeah, ultimately a market will get to balance. It will get to equilibrium. If you've ever heard the trope, like sell the news, buy the rumor. If you've not heard that, if you go down the investing route, you'll hear that one. So what is this? It's the idea that some news comes out, like it's actually been realized, it's a real thing. At that point, everyone who's going to benefit from it has already taken a position around it. The idea is that it's priced in. So the event happens, and then it goes. I was talking to the CEO of a publicly traded company here in Colorado a couple weeks back, and he was lamenting to me. He's like, like one of the horrible things about being a CEO of a publicly traded company is we had a killer, we had a fantastic earnings report, and our stock sold off like 10%. And he's like, I don't understand. And I was like, well, bro, it's I didn't say bro, I said his name. In this case, we'll call him Dave. I was like, so Dave, there's a mechanics to that. It's that participants up into your earnings were actually taking position, believing you would do exactly what you did. They were buying the rumor. The belief was that you were going there. Once it was realized, they were taking profit. They're like, great, I made the right call. I'm taking profit. Okay, who's the laggard in this scenario? Is the laggard in that scenario is the person who buys it on the news. So it's already been priced in. The hype, we have the news, which increases the efficiency, and so then they're too late. So that again reinforces why we talked about last night. You want to be not the first, not picking bottoms, not picking tops, but have enough information that I have some structure around something, and then, but I'm still ahead of the bulk of this. That then provides the opportunity. But then how do I allocate? How do I allocate? Okay, let's go back to this idea of I'm 100% allocated. So let's say that a market loses 20%. We had that happen last year where the S&P 500 lost 20% in April. So if you're 100% allocated fully and you lose 100%, you lose 20%. So we lose 20%. I'll now be at 80K, right? How much does the market have to appreciate to get back to break even if I'm 100% allocated? What you find is because you're now taking that percentage from a lower value, I need to see it go up 25% to get back to break even. Tracking? Now, here's where this is really interesting, is that if I instead say I want to be 80% allocated and 20% in cash. So rather than being fully allocated, I'm 80% allocated. So I have 20% of just free bullets. I can do whatever I want. All right, now what happens? We still drop the 20%, but now down here, I buy. So I have 80K, and then I buy 20%, and then we appreciate 25% relative to that price. I will not be at break even. I will now be at 110% of where I was before. Allocation matters. And it works both ways. It works in a way to get a better position. It also means that when we do have black swans, I am not massively exposed. Okay, one of my recent challenges is dealing with users on our platform, and so Miiflo is a platform that gives you a new playbook, and we are presenting investing ideas using options as the primary vehicle, and we're teeing them up for you, and you're building a portfolio around that. But allocation is a key component of that, because we know, hey, black swans happen, and we actually had ideas recently that were impacted by black swans, and I mean, it's completely reasonable. Users are like, oh, I don't like that I lost on that investment, and I agree. I have investments that don't work, and I don't. It's still not a great feeling. However, what's the reframing of this? Is that, yes, that one lost. That was a black swan. Like we set that up the way that we would set it up, and still it went poorly. And that will happen. Like, you can have the right process and the wrong outcome. But imagine that you were 100% exposed to that. Like, all of your exposure was in that thing. And then you had that outcome. That could be devastating. If you're partially allocated to it, well, now I can adjust. So like, as my mentor was like, don't go for perfect, go for adjustable. I need some room to be able to adjust. So, a great takeaway is, if you go, after watching this and you have a portfolio, whatever it is, whether it's a IRA or 401k or Acorns or something like that that's got you, are you 100% exposed? By the way, that will be the default. The default setting will be, I'm 100% exposed in a vehicle. That is not wielding risk wisely. That is increasing your risk. It's increasing the risk, while unlikely, but the impact of the black swan, when it does occur, will be significant again for you. Like, my father-in-law spent a lot of his time thinking about how to retire, and he really planned this whole thing. And then 0809, and because of how he was structured, he still had to tack on another 5 years of work before he could actually retire, because he was overexposed, because he was in vehicles that were like completely exposed. There was no wiggle room through the financial crisis, and so it delayed his outcome. Being fully allocated is not a way an effective investor works, whether they're using the current playbook or a new one. But it's a very accessible tool. So as you're thinking about your mix of investments, how allocated am I? I'll give you another example. Let's look at the world that we're kind of in at the moment. So the entire global equity market is about give or take about $130 trillion. Okay, so all equities, like America, Europe, Asia, like all of the products that I can do in an equity space, because there's six asset classes in the world. Okay, so there's equities, there's metals, there's energy, there are rates, there are currencies, and then there's another one we'd call softs. So this would be like cotton and coffee and cattle and grains and stuff. Okay, but these are the six asset classes in the world. Equities is the largest, 130 trillion. Okay, metals right now is I think it's like 5 to 6 trillion. Okay, so let's look at these buckets. So I've got a 5 trillion bucket and I've got a 130 trillion bucket. So there's this guy right now going around. Maybe you've seen him on Instagram or something, but a guy named Ray Dalio. Ray was the founder of one of the most successful hedge funds in American history, Bridgewater and Associates. Regardless your take on him, I find him to be a pretty prudent guy. He's written a number of books around the changing world order. Like, we're in the midst of a changing world order. Ray saw that coming, and he's been trying to tell people about it for quite some time. So, for someone who's seen it, and now we're in it, people rightly go, well, Ray, what do I do? What are the things that I want to invest in? And one of the things that he has posited is like gold and Bitcoin. All right. So let's talk about this, and let's talk about how it relates to allocation. So I have seen too many, unfortunately, different posts on social media that have said, hey, Ray Dalio says that gold and Bitcoin is where to be in the changing world order. And so then the recommendation is like people are putting all of their buckets in gold and Bitcoin. And what's even Ray's thesis around this? And Ray's not the only one, is it comes down to market cap. So I have 5 trillion and I have 130 trillion. When you have, let's say, a risk off event, so let's imagine that we had something like a financial crisis, or even worse, a depression. When that happens, investors and humans do predictable things. One of those is they will look for safe havens. Like, equities will take a massive hit and people will get out of them. Well, the question is, they will try to go into something that will not take the same hit. What are those things? Metals. Now, Bitcoin, is somewhere between an equity. It's somewhere between we can just say crypto in general. It's somewhere between an equity and a currency. We don't really know yet where that's going to be. If you look at the Chicago Mercantile Exchange, they would say it's an index. How it's behaving currently right now, we'd say it's an equity index. It's not the same thing as gold as a safe haven. But regardless, even if we look at crypto, the market cap of crypto is still in this kind of like 5 trillion world. Okay. So if I take people out of this, it does not take much spillover from this one to this one, whether that be metals or crypto, to significantly increase the value of those assets. So this is the base case. It's a structural case for why to have exposure to gold and Bitcoin in a changing world order. Because it's like, if you have a risk-off event and people get out of equities, this big pool, and they start looking for something else, there's a finite number of places that they can go look. One of those places is going to be gold or Bitcoin, and so they're going to grow. All right, great. So then we see people saying, I'm fully allocated into this. But then, not too long ago, a couple weeks ago, someone actually asked the question, hey, Ray, how much exposure do you have to this? Like, people are going around and saying it. What do you think of his allocation? How allocated was or is Ray Dalio to metals and Bitcoin, even given this mechanic and things that are most likely to be? It is in fact 1%. 1% is the allocation. Just one. Just one. Like, is it great to have some exposure? But here is a very successful, very effective investor, and he's saying allocation in my risk exposure to an investment idea is the way that I'm effective. You know, like if I'm overly exposed and this doesn't play out, now what would happen? Like if we don't get movement into these assets, they don't increase value. Now I'm locked into this thing, and it goes back to what we talked about last night, opportunity cost. And now I'm losing, even if like the actual price isn't moving, I'm still losing because of opportunity cost that's in play. Okay, allocation is a really key place of how we do that. So we'll talk about like how do I even think about allocation, and then within that, allocation is tied to the paradox, and the paradox is diversification. So this is one that you'll hear. I even heard Jim Cramer. Jim Cramer. So do you know this guy? He's kind of mad. he's hashtag mad. So Jim Cramer, Mad Money on CNBC. He was talking about NVIDIA the other day, and NVIDIA had a bad day. And he's like, well, but hey, it's okay because diversification. This is the principle of diversification. Like, you know, you need to have it in different buckets. Couple things. So in principle, the concept of diversification is wonderful. It's like, yeah, I don't want to be fully exposed to this thing. However, it has its drawbacks. And then the other question is like, what is actual diversification? Okay. So, let's look at a couple of these. So let's look at the S&P 500. All right, the S&P 500 has had 3 back-to-back years of greater than 10% gains. In fact, like close to 20% gains, back to back to back. And of those gains, greater than 90% were driven by 7 companies. So if you were diversified away from these 7 companies and you didn't have exposure to these companies, you, in being diversified, missed out on all of the gains. So part of diversification, the principle is that if this thing's not working, this thing will work. That's not a way to think about diversification. Diversification is a diversification of risk. Like the current playbook looks at diversification as, I want to have something that's working while this other thing's not working. No, it's we need to think about diversification of risk exposure towards the outcome. And if I am diversified away from where there's actual growth, that's not a great way to think about diversification. Not only that, let's think about diversification by posture. So there's a really wise market participant that I know of. I haven't met him yet, but he'll talk about like the world is long. All right, what does that mean? The world is long. It means that even when we talk about diversification, we're diversifying in the expectation that everything has to get more expensive. It has to get a higher price for me to benefit. Real estate, I need, I buy it at this price, I want to sell it at this price. Companies, I bought this company, I want to sell this. I have this product, like buy low, sell high, right? The idea. Even in the diversification, I don't have diversification of approach. So even in the ways that the current playbook has you diversified, but it's diversified in the idea that all of these things have to get to a higher price. They do not diversify such that if that asset goes sideways or lower, well then I have no diversification for those things. So what does an effective investor do? An effective investor says, I'm diversifying based in direction within a class. So I could stay in the class, the asset class, but then go, well, no, actually what I want to do is I want to have exposure that's diversified in direction. So let me give you a tangible example here. Clear the screen. So let's look in here. So this is our platform Miiflo, and Miiflo generates investing ideas every day based on kind of a proprietary rubric of 8,000 vehicles, 8,000 equity vehicles, whether stocks or ETFs, and then it organizes them. But what's fascinating about these is that they represent diversification of direction. So let's look at just the top row right here. Okay. This one, it's called a buy call butterfly. So this is a complex investment idea. It's based on AbbVie, which is a stock, but it's using 4 contracts. And this is basically saying, oh, we think AbbVie is going higher. So this is going to benefit if AbbVie goes higher. Now the next one is ACG or AGQ. Okay. AGQ is, I think it's an ETF related to gold. And this says, actually, we think it's going to go sideways. But the value of the investment grows because this thing is going to go sideways. This one, ACN, also believes that it's going to go not just up. This one could actually benefit if it goes up or sideways. Isn't that fascinating? So I'm using the one asset class, which is equities, but yet I'm diversifying how I'm exposed to the equities. Just here in the top row, I have an idea that is for this to go higher. I have one that will benefit if it goes sideways. I have one that will benefit if it goes sideways or higher. That is diversification, because now I have diversification of directional exposure. I no longer need things to just go higher to do better. In fact, last April, one of the types of strategies that we generate ideas for is for a classic multi-leg option strategy called an Iron Condor. I think we generated about 350 of those ideas in that period when the tariffs were coming out. That is that whole idea works because a stock is going this way. Actually, it's going like this in a range, but over, for a couple week periods, it's going to go like this. And this also brings up the idea of, we talked about nimbleness. I met a young lady a number of weeks ago, very interested in investing, and she came to my office and we were talking about investing, and she's like, well, what stock do I want to hold for 10 years? Oh, I have no idea. I don't know what's going to be like in 3 months. So having investing ideas that are nimble enough for what could happen in 3 months. So I invest in vehicles that are I'm going to be in for 2 weeks. Now, it's not like tomorrow. It is definitely more active than someone who's going to buy and hold. And then, to be fair, I still buy and hold, but I buy hold the S&P, the SPY, the full index, because then I at least have, in the diversification idea, I have exposure. So let's go back to the allocation piece real quick. Or I'm sorry, so it's still on the diversification aspect of this. So we talked about in the S&P, if I had those 7 companies, right? Well, if I buy the SPY, which is an ETF, it's an exchange traded fund, and it's a one product that I can buy. There's another one called the VOO that's from Vanguard. Basically the same thing, but they both match the performance of the S&P 500. So it's great to have exposure to something like this, because when you have 7 companies that drove all the gains for a couple of years, you were exposed to them because those 7 companies are in those indexes and they're in those ETFs. So you get that. That's a way. That's a diversification by having a sectorized or an indexed exposure. But all of those still require that we go up and to the right, even those 7. What if we have a period of time when none of these stocks go higher? If we go back and look at the 70s, when we had another period of persistent inflation, we had an S&P 500 that from entering that period and exiting that period, you notionally lost money because of inflation. Like the prices and the appreciation was not high enough to get past the inflation. Therefore, you lost money. We're in a very similar period now. But there were lots of opportunities if you had ways to construct ideas that did not require the investment idea to go up and to the right, to still get your equity curve to go up and right. So that's a way to think about it. It's not like I don't need the idea. So idea does not need to go up and to the right. My curve, my equity curve, that does need to go up and to the right. So I can actually have diversification of approach. And this is one of the really great things about, you know, the playbook that I think is the next playbook, is the new playbook that's nimble, that's risk focused. It's built around probabilities. It's thinking about allocation. It's knowing where a target is when you enter. So let's look at some of these ideas and what I mean by like I know the target when I enter. Okay, let's just kind of scroll through. Okay, like here's one from here's GLD. So this is an ETF that tracks gold. All right. Now this is a sell iron condor, and it's a idea built with 4 different option contracts all at once. The maximum potential for this, the max profit is $1,318. The capital required is $3,700. So $3,700. And what we say that the max profit was, so 1318 and 3782. I'm gonna get my calculator here so I give you a good number. So 1318 divided by 3782. So that is a 34% approximately return on capital. So I'm going to see potentially 34% return on capital in a number of weeks. About 3 weeks is where you're going to see that return in a number of weeks. So going back to, you know, what's possible. The current playbook says 6.7% inflation adjusted over a year. This is 34% in a number of weeks. Now, would I be wise to put all of my chips in that bucket? No, because while this is probable, in fact, this is built based on probabilities. It is most likely that GLD will stay between 492 and 421 for the next number of weeks. It'll stay between those prices. So this is actually going to benefit if we stay within a range of prices. We lose direction, I actually will gain in equity. Okay? But while that's likely, I'm not going to put all of my chips in that basket. So that's where allocation comes in play. You know, as a general rule, like on our platform, we recommend not more than 25% in any one idea, because I'm diversifying around probabilities. But in stacking probabilities, if I have spread exposure via allocation to a number of things that don't require to all be in sync, I'm stacking probabilities in my favor. So is then it reasonable to think that I'm going to see more than 6%, you know, more than 15% a year? Absolutely. But that's the process meets the playbook. Okay. Another part of that is 25% is always unallocated. So I always have capital on the side that I can adjust. And that's part of that allocation thing. Very different from how the current playbook is in play. It is fully allocated. It is one direction, and it is capital intensive. You know, here we have much more efficient use of capital. And that's another way that effective investors get towards their outcomes, is that they are efficient with the capital. You know, I can have exposure to something and get the same return, but much, much less capital required. Therefore, if it doesn't work, I get more cuts at it to get to that outcome. So that's a key piece in going through that. So then all of that leads to kind of the really big question, and that is, how do I cultivate confidence? Because that's a lot. That's a lot. That's a lot to do. So there is a framework, and it's called the 4 stages of confidence or competence. Right, 4 stages. 4 stages. So stage 1. So stage 1, stage 2, stage 3, and stage 4. So let's talk about stage 1. So stage 1 is what we call an unconscious incompetence. The astrophysicist Neil deGrasse Tyson says the great challenge of our world is knowing enough about something to think that we're right, but not knowing enough to know that we're wrong. So someone who is in stage 1 development can be someone who's like, I've got this figured out, and they don't know that they do not have it figured out. That's an unconscious incompetence. The first and best step for them to go is to go, I actually don't have things figured out. And that's the beginning of moving toward stage 2, which is a conscious incompetence. So I know that I don't know these things. Oh my goodness, this is such a wonderful place to be, because when you know that you don't know something, you now know I can go know. I can go learn and build this thing. And that leads you toward stage 3. Stage 3 is a conscious competence. So I've gone from I know that I don't know to now I've gone and cultivated something that I do know. But here's the thing about this one. This one is a hard place, because I know, but it's clunky. It's not intuitive. It's not instinctive. It's something that takes a lot of effort. But here is the place where we really cultivate confidence, is that if we do lots of reps around something that actually has some efficacy to it, some effectiveness to it, this will ultimately lead us to stage 4. And stage 4 is an unconscious competence. This is the person who has, they seem to operate from instinct, but it's a honed instinct. It's not something they just happen to have. They cultivated it. Okay, so if you want to be an investor who over time is very confident in what you're doing, this is not going to be an over the night thing. It's going to be actually a fairly long period. To which, here's kind of where we land the plane. What I'd like to do is, like, over the next 6 months, I'd like to invite you to join me in helping you build that confidence. And you're like, 6 months? Whoa, like that's a lot. Okay, sure. But we're talking about outcomes. Some of these are 35 years. Is it worth it to spend 6 months cultivating confidence that then you can deploy for 34 and a half years? I think so. I had a wonderful friend and mentor that told me this mantra of go slow to go fast. Right? We live in a world where everybody wants to go fast to get fast done. And I feel that too. I don't want to have to wait. It's the classic challenge around instant gratification. I want this thing right now. I want to be at the weight that I want to be right now. I want to have the income that I have right now. And part of that is just being human. But the way to get to these things is no different than it's been for centuries, is that I have to cultivate this. And if I do it with deliberate practice, I can go slow right now. But then with confidence, I can go really fast. And I'm going, and I don't have to check it. I don't have to I'm operating from stage 4 confidence. Or competence. So this is the invitation. So this weekend, we're going to offer you a way to step in and join us with Miiflo in a practice environment. This is not a real investment, although along the way you may step into some real investments, and that's fine. But you're doing that around a framework. But the idea is hey, we're going to show you what this new playbook looks like. And I know it's new, it's exotic. You've never seen this stuff before. It seems daunting. Okay, so let's not let's not go in here and think that we're going to get the outcome tomorrow. Let's spend time cultivating that confidence. And so we have a plan on Miiflo. It's $25 a month that you'll be able to do this. And over this next 6 months, whoever has practiced, and in their practice, and we'll talk about this weekend, like what the parameters are of this, whoever has practiced the best, we're going to give you $5,000 to actually put and deploy into a real investment. But you will have the ability and the capability to be able to do that because you spent time going slow to go fast. So that's going to be our mantra in this. And so, these 3 nights have been around, like, how could this be the first bit of 20 hours? I've tried to give you an introduction to things you've likely not heard about when it comes to investing that would shorten the opportunity cost of just not even stepping in. Like, there's so many people that I encounter, they go, I don't invest. Like, I don't have time. I don't have money to do it. These are perceptions that have been built up of, like, only those who have time and only those who have money can figure this out. It's just not true. It's not true. You don't have to have a lot of money. There are ways to construct these ideas that are very capital efficient that give you asymmetric reward for risk. But once you start seeing the world this way, you won't see it another way. You'll see it in this way that is like, oh no, I'm thinking about allocation. I'm thinking about risk as a tool. I'm thinking about diversification of direction, not just diversification within asset classes. And then I'm thinking about, okay, even in all of that, it's me. Like, it's the dial of me and how good I am that really drives all of that. All of that mixed together is stacking probabilities of success that will lead toward the outcome. Is it a guarantee? No, but the stacking of probabilities significantly increases the probability. And we all, every day, live in stacking probabilities. We get in cars and we drive across town, even though we know that I can have a car wreck that could end my life and that people die every day in car wrecks. But why do we do it? Why do we still get in a car and do that? Because most likely it won't happen. People get on airplanes and they fly across the country, thousands of flights every day. And yet there's these horrific plane crashes and people die, but yet people still do this. Why? Because it's so unlikely. We stack probabilities every day and we go out and we walk and we have a belief in an outcome because of the probability. So all we're doing is we're just borrowing that you already do really, really well. And then we're going to deploy it towards your investing outcomes. And we're going to walk you through, like, how to do that and how to allocate this. But it's a practice. So that's why it's like, let's practice. So this has been like the first couple hours towards, your 20 hours of deliberate practice. Well, we're just going to extend that. And the idea is, if we could put you in a playbook, this is where the kind of the idea of the $5,000 comes from, is if I have, let's just say, if I could get 25% a year, if we go all the way back to night one, and we talked about the current playbook says, I want to get to $3 million in 35 years. I need $23,000 a year for 35 years to get to 3 million, right? And we talked about, well, what if I could turn the dial, and that's on 6.7%. What if I could turn it to 25%? I need $300. Well, if I have $300 invested and I grow at 25% a year and I do that for 7 years, I get $5,000. So what we're asking is we're going to say, hey, give us 6 months. So 6 months. And the idea is that we're going to give you a skill that's going to serve you for 7 years. Because, like, whoever has shown the best, we're going to give you 7 years ahead in this framework. And I would love to see that. I would love, like, this is a way that we can reshape the way that a lot of resources are allocated without having to really change anything. And there are tools available that have been made broadly available, but what's not been offered is the skill to wield them well. So let's do that. Let's have fun with that. Let's play. Let's practice. Let's cultivate the confidence and see if we can't get to better outcomes. All right, gang. thanks so much for joining me for these 3 nights. Again, looking forward to talking to you more over the weekend and kind of open up the opportunity to step into this campaign for the next 6 months. And I hope that that's something that you'll consider and participate with us in. And what's the worst thing that happens is that you spend 6 months learning how to step into that playbook and do that with confidence. Like, how could you lose? like how could you lose? I think it's a great opportunity. So invest well, be water, and we'll talk to you soon. Cheers.